Hello everyone. In this video, I like to discuss about Mark Cuban's very famous zero collar option trade that he took during the dot-com bubble. Before going to the video, I like to answer some of the questions why I am making this video. Generally, among the Western traders, they got a little bit of more awareness about the options trading, that why is there and who is benefiting from that and all. Whereas among the Indian traders, I see most of them thinking that options trading is an easy way to make money. 3-4 years ago, a greater number of Indians were option buyers. They thought that the potential downside is minimum in option buying and they are willing to take those bets and its risk. Which is true. Now in the last 2 to 3 years, those who got burnt their fingers with option buying now turned as option sellers. Why? Because they are thinking that the probability favors them. It is also a true statement, probability favors them, I'm not denying that, but why now they are burning their hand? Then why the end results doesn't favor them? Probability favors or will take effect only if it is a relatively large quantity. It's like a similar to a casino. The owner will be profitable if the greater number of players played the more number of plays, then the casino owner's probability will materialize to him. That is the reason bigger casinos are always profitable, whereas the most smaller ones struggle to exist. It is a similar in option selling. If you want to be profitable in option selling, one must need a huge capital to bet against all these big guys like FIIs, DIIs, etc. Which I am confident that's not applicable to most of us. Especially at present, retail traders are not just has to outsmart the professional investors, they have to outsmart the computer in the probability game. Yes, if we want to make money in options, it's like we need to calculate faster than a calculator to outsmart it. Lately, since most of the trading in India is based on algorithm trading, to outsmart those, we need to understand the billionaire's mindset. So, I think Mark Cuban's option trade is a perfect example how rich people thinks with a real example and real purpose of the options existence. Let's get into the video. Bit of the background. Mark Cuban is the present American billionaire who was a millionaire in 1990s. He is a very famous inspirational US billionaire. I am following him in US Shark Tank from 2016 onwards. He owns a very famous basketball team. He founded the company along with his partner, which is called Broadcast.com, an internet radio company in 1995, specially targeting the sports segment. On April 1st, 1999, Yahoo acquired the Broadcast.com for $5.7 billion through Yahoo stocks. At that time, Yahoo's market cap was around $130 billion, which makes Mark Cuban an instant billionaire as Yahoo board paid 14.6 million Yahoo shares at the price of $95 per share to Cuban, which will equate to $1.4 billion. But they made the clause that he should not sell any Yahoo shares for the next 3 months. So it's a lockup period. Even in his one of the interview, he mentioned that the lockup period was his nerve-wracking time since it is $1.4 billion in one single stock. He also got some working experience in hedge fund. He said that he knows that the market is in the bubble. As per the tax rules, during the lockup period, Mark Cuban was allowed to short the index in which Yahoo was under 5%. So he gathered all his money, which is roughly around $20 million. He shorted a couple of IT tech index whose price movement is similar to Yahoo. He himself answered in Quora.com that he lost all of his $20 million in that shorting. But that small price got him covered the Yahoo price downfall during that lockup period. I mean, indirectly he hedged all his Yahoo stocks. That is his first step. He got the money of $1.4 billion. He wants to protect it, so he protected it. Thus, he sailed through the lockup period unharmed. Now he got this dilemma. He got $1.46 billion worth of Yahoo shares. If he sell it in the open market, he will lose 10 to 20% of the money since 14.6 million was the lot of shares. Also, if he sell the Yahoo stocks, then he will lose all his opportunities if the Yahoo price goes up means. So he wants the non-zero sum strategy. I hope some of you heard this word new. I am repeating again. Non-zero sum strategy. That is the mindset and strategy we need while trading. At least that's what I think. That means we should not lose whatever we got. All we need is the only gain. So he designed the collar option in that way with the help of Goldman Sachs analyst. A non-zero sum strategy. To understand this strategy, one should understand what is the collar option strategy means. Collar option strategy means we need to buy a put option in the downside and we need to sell a call option in the upside. So your yield probability will be like this: limited upside and limited downside. In that, he gone one step above and he designed the zero cost collar. Basically, he protected his whole money. On top of that, he wants the small premium if the stocks went up means. So, for his protection, he further limited his upside and created a perfect non-zero sum strategy. This is what he done. For each 100 shares of Yahoo stocks, he bought one contract of put options with a strike of 85 and one contract of call options with a strike of 205 was sold. In total, there were 1,46,000 contracts of calls and 1,46,000 contracts of puts traded. The premium of the put options exactly offsets the premium of the call options, and thus there was zero cost for this trade. All options will be expired in 3 years. After Mark Cuban's collar trade was entered, Yahoo's share price reached the atmosphere. It increased to $237 per share in January 2000. And everyone thought that Mark Cuban's collar trade seemed not so smart and thought Mark Cuban was not intelligent. Then the internet bubble burst and the Yahoo share reached the low of $13 per share in late 2002. Then Mark Cuban's collar trade turned out to be a stroke of genius. A great risk management trade that cost nothing to Cuban was able to pin down the whole of his value of shares, no matter how the subsequent movement of the stock is. So in summary, that is the billionaire's mentality. First, the sole purpose of options trading is created to hedge the portfolio rather than speculating through it. Second, you should not lose what you have, I mean the capital. And third, if you're trading, we need to formulate a strategy that is close to non-zero sum strategy. At least this is what I think if we need to beat the algorithm trading. So that's all in this video. Hope you all got some useful information. Please consider subscribing the channel and liking the video so it will help me beat the YouTube algorithm and it will also motivate me to do more. Please don't make any investment decision based on this as I'm not a SEBI registered advisor. I'm doing it for my and viewers' educational purpose only. Thanks for watching.